Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Roger Conrad. Roger has spent over 40 years guiding everyday investors to build more than $100 billion in generational wealth through smart dividend strategies, energy investing, and long game thinking. Nicknamed the Tortoise King, a nod to his slow and steady approach and love for classic movies like Conan the Barbarian and Dune, Roger has lived through 4 recessions, yet consistently outperforms the market with the average return twice that of the S&P 500. Roger, welcome to the show.
Thanks for having me.
I'm excited to speak with you today, specifically about how emerging cross-sector opportunities, especially in things like AI, energy, can fit into a dividend strategy. You know, most people think about dividends, they think of these stodgy Procter & Gamble type companies. But I also wanted to talk about your investor mindset, how you've created sustainable income streams, because I think people are interested in that, especially since there's like a lot of uncertainty going around. So it's another topic that I think people are interested in. Maybe to start, I found the nickname, the Tortoise King, and I kind of the slow and steady part you get. But how did you earn that, and how does that reflect your investment philosophy?
Well, I came out of what was called the investment newsletter business. It's still a business. It's not as big as it used to be. I actually went independent 12 years ago with a couple of partners, people I'd worked with in the business before. But the Tortoise King, the genesis of that actually was a copywriter. So we used to send out massive mailings to people, hundreds of thousands of people back in those days. And, the copywriters would come out with themes. So the way they kind of thought about this one was that because my strategy is basically centered around kind of slow and steady, that this would be a good moniker. So we picked it up, for our social media and so forth. And I do a Substack column now every week that's free, that people can go look at. It's called Dividends with Roger Conrad. In it, I talk about all things to do with income. But as you just pointed out, there are a lot of different aspects to it. And there's a lot of different ways to get your dividend besides just going to the bank, having a savings account or buying a large company that pays like 2 or 3% of a dividend. We can do a lot better than that. We have done a lot better than that over the years. And really by not doing anything particularly fancy, particularly flashy. The tortoise was not the flashy character in that fable, right? It was the hare. And there are a lot of hares that make money in the market. I wouldn't say that. There's a lot of different ways to make money. The way I'm comfortable with, though, is the steady way. And dividends make that possible because we get paid for holding stocks. And that's really the center point of the strategy is stocks, because stocks give you ownership in companies. They give you a piece of the growth of companies that are growing, that their businesses are growing and they're healthy. And they're doing things like, providing really the picks and shovels of the artificial intelligence revolution. That's a analogy that goes back to the gold rush, right, in the 1840s. And the people that made the most money during that gold rush weren't necessarily the people that were mining for gold. A lot of them never made anything. But the people that sold them the picks and shovels had a pretty sure return. So there's a number of those types of companies involved with AI. And they're really all around us. My strategy is encompassed really sectors. I focused a lot on energy. I focused a lot on utilities. I actually have a book about utilities. It's called Power Hungry, and it's still sold on Amazon, like every other book. So that's been a cornerstone. But also things like real estate investment trusts that now you can buy almost any kind of property. Other types of companies. Some big pharma companies we actually find interesting. So there's a lot of stocks out there. There's a lot of ways to get dividends while investing in growth. And I guess that's kind of the central element of it. We don't really ever buy anything just for the yield alone. We want to have a strong business behind it that's financially healthy and that has an avenue to grow, so it can grow that dividend, keep us ahead of inflation, Another thing a lot of people don't realize is that stock prices tend to follow dividends higher over time. So if you have a company that's increasing its dividend on a steady basis every year, it may not go up every year, but eventually it's going to follow that dividend higher. So you get capital appreciation as well as rising income. And again, it's a steady way to earn money in any environment. It's not, the stocks that I recommend haven't been unscathed in situations like 2008, 2009, when we had the financial crisis and so on. Pretty much everything fell then. But because they were solid, because their businesses kept making money, because they kept paying their dividends, they were the first stocks out of the gate when the recovery happened. And, if you've been around the stock market, I've been investing for like 40 years now. I've actually been in the investment business for about 40 years. It seems crazy. Never been dull. I've always really enjoyed it. But, over time, we've seen a lot of corrections, a lot of downturns. But, again, the one thing that I've found to be pretty much universally true is the strong companies, the stocks might go down, but they're really an opportunity to buy at those low prices. I mean, that's really not something a lot of people can do, is go into a stock market that's been crashing and everybody's saying, oh my God, I've got to get out of stocks, and everybody is getting out of stocks at the wrong time. So it's hard for people to go in and buy at those levels. If you can do that, that's extra, icing on the cake. But what I'm saying is, just buying and holding and steadily adding to positions. You can do things like dividend reinvestment, which just basically takes your dividend, buys more shares of stock. It's a very simple way to compound money. But there are all sorts of avenues like that you can take. And I use pretty much everything that I recommend for myself. And that's also sometimes is a proving ground, just prove it on myself. But again, I think dividend investing can really accomplish a lot of things for a lot of people.
When you're looking at a dividend stock or looking to add a dividend stock, what is the criteria you use? Because I see a lot of investors, their main criteria is yield. But dividend investing you can involve a lot of other things, like you mentioned, are they raising their dividends? You can look at different things like their payout, different ratios. What is your criteria that you use?
Well, it's interesting, I've been actually teaching a couple of young people how to go out and look for stocks, because I say, stocks, dividends, they're all around us, right? There's all sorts of things. I think one place you can just start out, when you're looking for dividend stocks, look for areas of the economy that are growing, or look for areas of the economy that you're familiar with. Maybe you buy a product from them and see what sort of dividend policy they might have. Now, I look at big screens of companies, through in various industries. So I know there are certain industries, and of course I've been doing this for a while. There are certain industries that pay big dividends. They can afford to pay it on a sustainable basis. So sustainability is extremely important, obviously, as a criteria. So sectors like utilities, I mentioned that's a focus area for me. There's a lot of nice dividends in that area. The companies traditionally pay dividends. They want to pay dividends. Their shareholders are traditionally people that want to have dividends. Even the big institutions that now kind of dominate most of the stock market, they want to have the dividends too. It's it's a part of their return, and it's steady, and they can do it. There are other sectors like pipelines that maybe don't have that quite of the reputation of utilities, but also have those types of characteristics that they can grow their dividends over time. And because they have these long-term assets, gas pipelines, just, kind of a boring business, bringing natural gas to power plants or for export. They operate under long-term contracts. The assets last a long time. Those are ideal for paying dividends. Now, when I'm choosing in between those sectors, or if I'm just looking at a straight screen, you mentioned the payout ratio. That's very important, because it's basically measuring how the company makes its money and how much of that money that it makes is it paying out in a dividend. Now, there's a lot of confusion with the payout ratio, and could be another podcast, really. But what is there's two elements of it, right? There's the numerator and the denominator, right? The earnings piece of that, what really are the earnings of the company? Because There's GAAP earnings, general accepted accounting principle earnings, that are the same across industries. But we know that all industries aren't the same. So some industries, for example, have a lot of things like depreciation. So, and to avoid getting too technical, they're just more suited to pay a larger percentage of their earnings out in dividends. There's other companies that frankly aren't. Some of that has to do with the product cycle. A big tech company, for example, that has a product cycle that's maybe 90 days, they're not going to be able to pay the same level of dividend because their revenue is just not that reliable. So I actually have a 5 criteria system, and I do apply it across all sectors, but I look at 5 things basically. So I look at payout sustainability, the payout policy that they have. Have they been able to sustain it? How's it compared to the earnings that they have? And the measure of earnings I might want to look at might be what's called free cash flow, which is basically the cash flow of the business less what they spend on, growing the business or acquisitions or whatever they have, like spare cash. That might be a better measure that I want to look at than regular earnings per share. I might want to look at what companies call adjusted earnings per share. So there's elements that go into that, but that's number one, sustainability of the payout. Number 2 is revenue reliability. And so we kind of touched on that, with some other comments I made just now. But that's basically, how reliable is this company's revenue, the money that it makes? If we have a recession, are they going to keep making the same amount of money? Are they going to make what percentage of that money that they're making now can we count on them continuing to make? Huge criteria. A lot of things go into that. And a lot of the things that I look at depend, it's kind of industry by industry. Number 3 would be regulatory concerns and legal concerns. And I'll just give utilities as an example. Being hit by a wildfire, it's suddenly all bets are off. And we've seen big companies like PG&E and Hawaiian Electric more recently, have to eliminate their dividend because wildfire basically turned the whole business on its ear. And even though they're made whole at the end of the day, there's a period there they just can't. They don't have the money. They can't pay out the dividend. So those are types of issues we look at. I'm mentioning utilities, energy, those types of the bigger a business is, the more high profile, the more you have to look at. The more I look at the regulation side, and also the legal side, because getting sued is a part of business, I guess, some more than others. But you want to be aware of those issues. Number 4 would be financial strength. And these are different. They're different things that are important at different times. I think right now, having an investment grade credit rating is really important for companies, for consumers as well. If we do hit into a recession, that's going to be a tremendous difference maker between what companies can borrow money for. If they're rated, say, BBB or higher, or less than that, they're going to be paying a whole lot more. And they may not even be able to borrow any money. They may not even be able to roll over the debt they have. So all that's a threat to the dividends, and that's all something I want to know about with the company. The number 5 is operating efficiency. Again, this is another thing that varies. What works at one company works for another. But, just as an investor, you can look at things like the margins and how consistent those have been. So I put all those things together, and I assign a quality grade to companies that I look at, from just very simple, from A to F. I leave E out of it, but A is the highest, and then F's the lowest.
And when you're filtering companies, will you look at all sizes of companies? Like, a lot of times you'll hear dividend investing. Let's focus on a lot of it's the large cap and the bigger caps. But then there's probably small cap companies that offer dividends. But one thing I've heard is a smaller company, a small cap company, they shouldn't be providing a dividend. They should be trying to reinvest everything back into the company so that they can grow and get to the bigger stage. Do you see opportunities that fit your 5 criteria in small caps, or are you limited to large caps and maybe mid caps?
Well, the larger companies will probably have a longer history of paying dividends at certain rates, but the small cap companies can be really interesting for another factor, and particularly in kind of specific industries. We've seen a lot of merger and acquisition activity pick up in the utility business. I think the one disadvantage you might have buying a small cap is that there are likely to be fewer people that have looked at it. Doesn't mean that you can't just look at it yourself.
How do you balance the income like that a dividend produces with growth? Some people will say, I don't even bother with dividends because if I want an income stream, I'll just sell some of the appreciation of the stock. Once a dividend is issued, I'm getting taxed on it, whereas I can control the tax aspect of selling a capital gain. On the other side, you do, if the stock doesn't go up, obviously there's nothing to sell, whereas most likely the dividend, you're going to get the dividend. But how do you balance those two from, you want both, obviously. You want growth and income.
I think really a lot of times people tend to kind of bifurcate the market too much in terms of here's growth and here's income. In reality, good companies can offer you both. The strategy of selling stocks and using that for income as opposed to just collecting dividends, that's a strategy that works really well in a certain kind of market, particularly mainly when stock market's going up, right? So I remember back, and this goes back much earlier in my career, but in the late 1990s in particular, the NASDAQ was doing so well that you had a number of advisors out there. And again, this was the day when, there were newsletter advisors were pretty influential because companies would send out hundreds of thousands of pieces of mail. Newsletters that are now maybe 3,000 or 4,000 would be, 200,000 or 300,000. So these guys were a lot more influential there, and they were telling people in the late 90s, dividend investing is kind of a loser's game. When you want income, just sell a stock. Back then, it was actually more advantage because you didn't have qualified dividends. That distinction was made in the OOs. So capital gains were advantaged relative to dividend income. So it actually made more sense on that side than it does right now. But, again, that kind of strategy worked well. But I talked to so many people in the subsequent years when, again, the tech wreck happened then and the market just completely shifted and it became a lot harder to get capital gains. And anybody who did what most people did, bought a whole bunch of, high-tech information technology companies. Some of these are still leading the world, but they bought them at a time when the prices were high, and the whole idea of selling off a piece of what you own and so forth really didn't make any sense. I will just say right now, we're in a kind of a similar situation, but it might be even more dangerous for people, particularly if you are invested solely in S&P 500 ETFs or funds or target funds or any kind of thing like that, passive invested that focus on the stock market, because the number one investment tends to be the S&P 500 ETFs and related investment. Right now, the S&P 500 is actually more weighted towards stocks that have been going up for a long time. And really, I'm talking about the big 8 tech stocks than it was back in 1999. And I'm not arguing that these aren't great companies. I mean, and they are extremely profitable, but they are also extremely expensive relative to their business prospects, just as they were 25 years ago. Market history doesn't always repeat, but it does often rhyme. I think when you get to that point where you're that concentrated in a handful of stocks, in basically a strategy that has worked for a long time, and everybody's assuming it's going to keep working, that's an extraordinarily dangerous situation. And I just don't think people are really aware of that either.
Yeah. All right, Roger, that's all the questions I have for you today. I want to thank you for joining me on an episode of the show. Before we close, where can listeners go to contact you, learn more about what you do, follow you?
The easiest thing to do is just go to Substack, the application Substack, and look for Dividends with Roger Conrad. You can read my columns for free. You can actually go in and read all the columns that I've ever written. That's a nice thing about the site that they have there. If you're really interested in something like utilities, if you're interested in energy, a couple of websites for you. One is conradsutilityinvestor.com. And again, it's like conradsutilityinvestor.com. And the other is energyandincomeadvisor.com. You can just type in my name, Roger Conrad, and Conrad's Utility Investor will come up as well. But a couple of ways if you're interested in what I've had to say, I would love to hear from anyone.
Great. We'll include all those links in the resources section of the show notes. Thanks again, Roger, and thank you to everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.